Okay, what we're going to do here is we're going to find a bond's price given its yield to maturity. This is a typical task you're going to do in an intro corporate finance course. Note that the bond we're talking about here is your plain vanilla fixed rate bond. After that, we're actually going to find the yield to maturity given the price and then talk a little bit about the relationship between bond price and yield to maturity. So, first and foremost, in any end of chapter problem or exam, you're going to be given information like this. You might be given the par value, you might not. It's common just to assume the par value is 1,000. So if you don't see a par value is 1,000, you can just assume that. Then we're given a coupon rate, payment period, and a years to maturity. And this is from the bond indenture, so this never changes. That's important to know. Then you'll get also a yield to maturity. This is the discount rate on the bond. This will change all the time, right? This will fluctuate daily, or as the bonds traded in the secondary market, this will fluctuate. But these, and it's not really pointed out, these are from the bond indenture, they will never change. Also, I want you to, when you see this, realize that the only thing that this is here to do is to tell you the structure of the bond payments. So in other words, when you see par value 1,000, coupon rate 5%, payment period annual, years to maturity 10, what that means to you, and all that it means, is that this bond is going to pay 5% at the end of every year for the next 10 years. That's, it's going to pay $50, right? So 5% times $1,000 is going to be $50 at the end of each year for the next 10 years. And then in year 10, at the end of year 10, it'll also pay you your $1,000 par value back. So all this is here to tell you is that if we have a year here, right? So this is year 1 through 10. The bond is going to pay $50 in year 1, $50 in year 2, $50 in year 3, down to year 9, $50 in year 9, and then $1,050 in year 10. Right? That's all that is here to tell you. Kind of once you get that payment structure, you can forget the rest of that. Right? So all this is here to do is give you the payment structure. Now you have the cash flows of the bond, the payment structure. Now once I give you the discount rate, which is the yield to maturity, you can get the bond's price, which is just its present value. Remember, the bond's price is just the present value of these payments at the yield to maturity, at the risk, the discount rate applied to these cash flows in the market. So this is where students will say, okay, well, what formula should I use? And I usually answer whatever one you want, right? So this is just an application of what we learned previously, our time value of money. So you could, in a spreadsheet, it's really easy. You could discount these individually at the present value of a single cash flow. So, $50 divided by, here we'll talk about a 7% yield to maturity. So $50 divided by 1.07 to the first power, and then this would be $50 divided by 1.07 to the second power. Discount each of these individually. Sum them up. That gives you the bond value. What is traditional is to note that we have a 10-year $50 annuity here. So we can use an annuity formula to get the present value of these interest payments, and then we can just discount the $1,000 par value individually at the end. That will give you this formula here. So we have, this is the present value of an annuity, so these are our interest payments. This is our par value principal. So the idea here is $50 payment per period here, which is annual payments at the end of the year. 1 minus, here we have our 1.07. This is our discount rate to the 10th power. So this is present value of an annuity, and then discount the par value back 10 years at 7%. Right? And again, the only thing, one thing where students sometimes make a mistake is, again, this 5% is only to get us our payments. All the discount rates in here are the 7%. So we're discounting the par value and the coupon payment at 7%. Now, of course, what you could do, right, is if you wanted, you could note, well, this is also, I could do this as a 9-year annuity because $50, and then just discount the, $1,050. That'll give you, that'll give you the exact same answer, right? So there's multiple ways to do this. That said, the most traditional way, at least in terms of textbooks, is to do this. And keep in mind, people used to not have spreadsheets, so doing that was a little bit harder doing it individually. This was the traditional way to and if you want to punch it into a kind of a financial calculator, that was the way to do it. Even though I'll do it often this way in Excel. Great, so if we get the present value of this, so the price of this bond is going to be 859.53, so we have 859.53. Now, we'll stop here to note a couple things. First, anyone can make mistakes doing these calculations, so the first thing I check is to make sure that this value is less than 1,000. We know it's going to be less than 1,000 even before we do any calculations. Why? Because the discount rate is higher than the coupon rate. So what's happening here is when, this a bond was sold to yield 5%, but the market is saying, no, right now this bond, given the risk of the cash flows, should yield 7%. So the payment on these bonds will never change. This cash flow structure will never change. So to make this bond yield 7%, what we need to do is say, okay, well, I'll buy it for less than 1,000. And then that $50 payment divided by 859 is something greater than 5%. It's not 7%, but it's something greater than 5%. And then what also happens here is you bought it for 859, and then in 10 years you're going to receive $1,000 par value back, so you're going to get roughly like $140 in capital gains. So when you take into account sort of the higher rate on it and then the capital gains, the bond will earn 7%. But knowing that the yield to maturity is greater than the coupon rate, I know this will be less than 1,000. Right? And then conversely, if the yield to maturity is less than the coupon rate, the bond value will be greater than 1,000. If the bond value is less than 1,000, we call it a discount bond. If it's greater than 1,000, we say the bond is trading at a premium. Good. So this looks reasonable. The next thing to do, and this is where students often make mistakes, where it's actually very easy, but what I think students are trying to do is remember formulas, right? So the next thing is, well, most bonds are not, they don't make annual payments. They make treasury bonds or corporate bonds, they make semi-annual payments, right? So payments are usually semi-annual. So what happens when we switch to semi-annual, right? A semi-annual payment period. Now the period is 6 months, right? So the only thing we have to keep in mind is this coupon rate and this yield to maturity are quoted rates. Remember what that means is they're not effective rates. The quoted rate is the effective rate per period multiplied by the number of periods. So what this is saying is the coupon rate per period is 2.5%. The yield to maturity, 2.5% over 6 months. The yield to maturity is 3.5% over 6 months. So all we have to do is, take into account the new payment structure and the new discount rate. So the payment structure is simply going to be, just as the par value is not affected, the coupon rate is going to be 2.5% over every 6 months, and the number of periods, right, is going to be 20. Years to maturity is 10 times 2 payments every year is 20. So what this is going to do is it's going to pay $25 for the first 19 years, and at year 20, not 19 years, 19 periods. So it's going to pay $25 for the first 19 periods, and then in the 20th period, it's going to pay $1,025. Right? So all you have to, so this is pretty easy to do in your head, right? So okay, well, it's just 5% divided by 2 is 2.5, so every 6 months it's $25. See, what I think happens is students will start, a textbook or something may give you a formula to kind of, to write it out like this with a semi-annual payment. And the formula will start off something like coupon rate times 1,000 divided by 2, right? That's going to be our $25. And that's our, here, and then we want to do our annuity. And then what they'll do is they'll have the yield to maturity divided by 2, and then the number of years times 2. And when you write that as a formula, it's way too complicated. Right? It's overly complicated. You try to put it in Excel like that, you're going to make an error. I find that because all we're doing is dividing numbers by 2 and multiplying by 2, right? So in other words, let's say the yield to maturity is 8%, well then it's 4% per 6 month period. That's my discount rate, right? If the number of years is to maturity is 5 years, and I know it's multiplied by 2 for 10 periods. So these are not hard calculations, so I would just advise kind of doing them in your head and then putting them into the formula just like this. So right now we know the semi-annual calculation is going to be 25, and then it's going to be 1 minus 1 over 1.035. for the yield to maturity divided by 2, and then for 20 periods, right, 0.035 plus, again, the par value doesn't change, then we have 1.035 to the 20. Right, so I would just advise that instead of trying to, calculate all of these in place. When we do that, the semi-annual, I'll just write it here because it's going to start another interesting conversation. The price is $857.33. Oh, $857.88. Sorry, I can't read my own handwriting. If you can't read my handwriting, you're not alone. Excellent. So, good. So that's a semi-annual. Now, here's the first thing that's kind of interesting to discuss. Note, everything with the bond is the same. We just switched from annual to semi-annual. And if you notice, when we switched from annual to semi-annual, the bond price went down. That's kind of interesting. So we can think, well, why does the bond price go down when we switch to semi-annual? Right? Now, another thing to keep in mind, in the description of this video, I should put lecture notes. I have lecture notes online with bond calculators, which will allow you to calculate a bond price. So you can just put in whatever parameter. So you can calculate a bond price here. So I'm just going to further this conversation, I'm just going to put up a couple other numbers. Let's change this, right? And say, okay, well, let's say the yield to maturity is now 3%. So we'll keep all that the same. If the yield to maturity is 3%, then the annual bond, the price would be 1170.60, right? And the semi-annual bond is going to be 1171.69. So here's the thing. If the yield to maturity is 7%, as it is here, when we switch from annual to semi-annual, the bond value goes down. However, if the yield to maturity is 3%, 3% is less than 5%, so we know it's a premium bond. If the yield to maturity is 3%, then as we switch from annual to semi-annual, the bond value goes up. It does the opposite. The bond value goes down switching to semi-annual for a discount bond, but it goes up switching to semi-annual for a premium bond. So why might that be? And if you kind of get this, you're doing very well. This is a little bit of critical thinking with time value money and bond values and so forth. So give it a second of thought. If you want to think about it, pause the video here because I'm going to tell you the answer right now. So the answer here is compounding, right? So the idea here is when we switch from annual to semi-annual, we're going from no compounding to compounding. And if you remember, compounding has a larger effect the higher the rate. So when we're talking about a discount bond, the numerator, right, what we're discounting is the coupon rate, and the discount rate is the yield to maturity. So the compounding has a larger effect on the discount rate, right? So it has a larger effect on the denominator, so our discount rate goes up more relative to our numerator, and the bond value goes down when we switch to semi-annual. However, when it's a premium bond, the compounding has a larger effect on the coupon rate rather than the discount rate. So the coupon rate is going up relative to the discount rate when we switch to semi-annual, and the bond value goes up, right? So in other words, simply put, in whatever interest rate is highest has the larger effect. So if it's a premium bond, the coupon rate offsets the yield to maturity, but if it's a discount bond, the yield to maturity has more of an effect from compounding than the coupon rate. And that's why we're getting this difference. Excellent. I find that to be pretty interesting. Again, one of the more interesting things about doing these calculations. All right. So let's talk a little bit about the yield to maturity. Okay. One thing I'll go ahead and say is because I've done a couple other videos on the yield to maturity. There's some interesting aspects of it. The yield to maturity. There's one question: if you buy a bond and hold it to maturity, are you guaranteed to earn the yield to maturity? And the answer is no, because the yield to maturity assumes you reinvest at that same rate. So if I buy a bond with a 7% yield to maturity, it assumes all those coupon payments I get before maturity, I can reinvest at 7%. But if my reinvestment rate is lower than that, then my return on the bond will be a little lower. So that's kind of interesting. That's one of the reasons why zero coupon bonds are popular, because they guarantee so if you buy a 10-year 7% zero coupon bond, you're guaranteed to earn 7% per year, but not with a coupon bond because of that reinvestment risk. I have to reinvest this, reinvest this, reinvest this. Okay, so that's kind of interesting. One of the other things I talk about in terms of the yield to maturity, what do I talk about in terms of the yield to maturity? So one, let's understand what we're doing here, right? So at this point in the class, I say, okay, well, now we're going to get the bond price and we're going to calculate the yield to maturity. So what we've just been doing is we're saying, all right, we have the yield to maturity, right? And with the yield to maturity, I can get the bond's price. But now we switch gears and I say, okay, let's assume the bond's price, then we can get the yield to maturity. But that's kind of going like this. And if you note, this is circular, right? And you know, students have noticed this, and I'm really happy when you notice stuff like this. So in other words, you want the price, you need the yield to maturity. You want the yield to maturity, you need the price, right? There's no real valuation going on here. We're just translating. We're translating from one to another. Now, what I want to talk about for 30 seconds here is why we do this bond translation. Am I just wasting your time? And the reason why we do it is quoting a bond's price to you does not make too much sense, right? In other words, bonds do not have unique prices. They have unique yields. For example, a 10-year treasury note, right, issued today might have, the yield is actually much lower, but a 10-year treasury note issued today, let's say it has a yield to maturity of 5% and a coupon rate of 5%. So the bond's trading for par, 1,000. But a treasury note, a 30-year treasury bond issued 20 years ago is now a 10-year treasury note. And that 30-year treasury bond might have a coupon of 15%. It'll have the same, you know, any 10-year treasury note has to have the same yield. So this 30-year treasury bond issued 20 years ago, which is now a 10-year treasury note, will have a coupon rate of 15%, but a yield to maturity of 5%. So given what we know, this bond will trade at a very big premium. And then a 20-year bond, and we do issue 20-year bonds from time to time, issued 10 years ago will also be a 10-year note, right? So that bond may have, you know, maybe it was issued at a 10% yield, but again, it'll have a 10% coupon, sorry, but it'll have a 5% yield to maturity, just like all the other 10-year treasury notes. So that bond will have a different price. So when we talk about 10-year treasury notes, there may be many different 10-year treasury notes, all with different prices. So it's not well defined. It's not meaningful for you to say to me, well, what's the price of a 10-year treasury? No, I can look at my brokerage account, right? Because there I can buy bonds and I'll see a bunch of different bonds that qualify as 10-year treasury notes and they'll have a bunch of different prices. But that's not what you want. What you want is the yield, because all of those 10-year treasury notes will have the same yield. So you don't say, what's the price of a 10-year treasury note? You say, what's the yield? Right? So if you wanted to know what the yield is, and then let's say, so you ask what the yield is. Let's just say the yield is 5%, right? So then you can go in and for a particular bond, find how much to pay for it. Okay, so given the yields on 10-year treasury notes are for this particular bond, with this particular coupon, I can now get the price. So that's why what we're doing is somewhat meaningful. Or if let's say you bought a bond for this, then you could tell other people, I bought the bond for this yield. You know, I paid whatever this price, but given the coupon and so forth, this is the yield, right? So this is why we do this translation. If anyone quotes it to you, they're going to quote it in terms of yield, right? And then if you actually want to go in and transact in this bond, you have to then calculate the price. Also, if you want to tell anyone what you bought a bond for, you don't tell them the price, you tell them the yield. So that's why we're doing this sort of bond translation. All right, but we'll talk about like bond pricing or valuation, which would be determining how much we want to pay for the bond. We'll talk about how we go about that in other videos. So the idea here is all we do to find the yield to maturity is, well, let's say, we'll go back to our plain vanilla annual bond, annual payments, and we'll say, all right, this at 7%, this was the price was $859.53. So we can set this up in Excel like this. So when we find the yield to maturity, it's kind of easy because there's no algebraic way of doing it. We need a root finding algorithm. So the idea here is we just put it negative, the price 859.53, and so we'll put this in Excel, right? So in the top cell we'll have negative 859.53, then 50, 50, down into 1,050. We do have to have a negative here and then positive values, or positive and then negative to so that there's a root. If you just have all positive values, there won't be a root. So negative, like how much we're paying for it, and then positive, so cash outflow, cash inflows. Then all we have to do is in Excel, sit there and say equal to IRR, internal rate of return, and then choose all of these, and this will come out to say 7%. If you don't want to do this in Excel, you can also do this in Python with like SciPy's Optimize, or you can do it in R with Optim. Just optimizations, and all you do is say, this is the formula for the bond as a function of the yield to maturity minus the bond price, square that and say minimize it, and certainly minimize it to 0. Good. So now the only thing, again, which might be a little bit tricky is, so this is fine, but if we switch to semi-annual, then I'm going to have, I would have the semi-annual bonds price 857.88, and then I have 25 down for 20 periods, right? In the last period, it's 1,025. And if I do that, I'm going to get, the answer to this will be 3.5%. And then you have to keep in mind, that's not the answer, because we quote yield to maturities as their quoted rates. So to get the yield to maturity, you have to multiply this by 2 for 7%, right? So the idea is always remember, if you're asked for a yield to maturity, that if you calculated it semi-annually, that you multiply by 2 to get that annual quoted rate, right? So remember, these are quoted rates. Excellent. Last thing I want to do here briefly is talk about bond risk. So what we've done here is we've talked a little bit about how to get the bond's price given the yield. So if we look at the bond's price and we look at the bond's yield to maturity, now that you know these calculations, you can calculate the bond's price for many different yield to maturities. And if you plot them, what you're going to see is something like this, right? Convex, right? So it's decreasing, but then decreasing at a decreasing rate. So this is sort of the relationship between a bond's price and a bond's yield. So the idea here is the higher the yield is, the lower the price. So the big takeaway from this is, well, bonds are risky. See, a lot of times I'll talk to students and I'll say, okay, well, is a treasury bond risky, right? And they'll be like, oh, no. When, in fact, absolutely, a 30-year treasury bond is quite risky. I mean, think of what we just looked at here. If you bought this bond for a 5% coupon, and then and shortly the bond goes up to, so it has a 5% coupon, and what I'm assuming here is when you bought the bond, it had a 5% yield to maturity, so you pay $1,000. So let's say now the bond's yield goes up to 7%. Well, now the bond's price has gone down to $859.53. So again, you've lost like $140, roughly 14% on the bond. The bond's yield to maturity goes up 2%, you lose 14%, right? So this is risky. Now here, one thing to keep in mind. Every once in a while someone will say, well, if you hold it to maturity, you haven't lost anything. Don't be that person is wrong, right? You have absolutely lost something. You hold it to maturity, you're going to get your $50 and you're going to get your $1,050 at the end. But the point is, for the same level of risk, you now could get $70 and $1,070 at the end. But you're only earning $50, right? So you absolutely have lost money, right? So what we're talking about here is so bonds are risky. This is called interest rate risk, right? In fact, I'm not going to go too much into this in this class, but the idea here is the larger time to maturity, the greater this sort of interest rate risk, the more sensitive the bond value will be to interest rate changes. So a 30-year bond has a lot of interest rate risk in it. A 1-month treasury bill has pretty much no interest rate risk in it. So if you want to invest in something safe, 1-month treasury bill, 6-month treasury bill, 1-year note, these are pretty safe. But as soon as you go to like 10-year, 20-year, 30-year bonds, These have a great deal of interest rate risk, and if interest rates go up, the bond values will go down dramatically. In fact, if you look at, again, we won't talk about it much in this course, but the bond is also more sensitive. The longer it is, but also the lower the coupon rate. And keep in mind, right now, coupon rates are very low. So if, not saying they will, but if bond yield to maturity on 30-year treasury bonds were to jump up, then the bonds would lose a massive amount of money, given 30 years to maturity and a very, fundamentally, what's a 30-year at now? Like maybe 1.4%, something like that, given a very low coupon. So, last takeaway from this, bond, this is the relationship between the bond's price and the bond's yield to maturity, and bonds are risky. Right? Excellent. Have a great day.